Hey, ambitious dentist, welcome to Start Your Dental Practice, the show for existing and aspiring dentists to take your dental practice to the highest possible level. I'm your host, Jonathan Van Horn, CPA and ABV, founder of DentistMetrics.com. In every episode, we aim to demystify the how to start a dental practice problem by bringing on world-class dentists, influencers, and consultants in the dental industry to pick their brain about how to get past the barriers involved from going from no practice to being a practice owner to owning your own successful dental practice. Hey guys, it's going to be a self-hosted podcast this week. What we've got going on this week is pretty interesting. I spent a lot of time in our firm analyzing our clients' results from a financial perspective. So we spent a lot of time actually looking at their financial statements, their profit and losses, to try and see if there's any trends that we can spot so that we can, improve their output of dollars, their expenses, so that they can hopefully cut a few percentage points off from their overhead so that they can make a little bit more money at the end of the year, get to bring home a little bit more of all that work that is coming out every day in the practices that you guys are in. So I've actually done an analytical study, spent a lot of time, energy, and effort compiling a lot of information for what's going to be a study of about 25 dental practices. That's 25 separate practices from all over the country in different stages of revenue cycles. They have different types of demographics. They have different types of people involved in their practices. And in this episode, I'm actually going to share with you some of the trends that I'm spotting in all of these different practices. I'm going to show you some of the things that define an incredibly profitable practice, as well as some of the things that indicate that you may not be as profitable. So we're going to be talking about some of the different revenue levels of things that I'm seeing, as far as I see that practices that are in this revenue range are typically this profitable. And I'll kind of give you an idea of what I think about those different things. So this episode may go a little bit long, so we may actually turn this one into 2 episodes. And the way that I did the study is I actually separated the study into a group of 13 practices and then a group of 12 practices. The group of 13 practices are all practices that are going to do over $1 million in revenue this year in 2016. So what I looked at is I looked at the first 6 months of their activity, of their financials. The other 12 are practices that are going to do over $500,000 this year, but less than $1 million. So I grouped that into 2 separate categories for a very specific reason, in as much as that there's always this preconceived notion that the bigger the dental practice is, the bigger economies of scale as you get, the more money you can make, et cetera, et cetera, et cetera. So we're actually going to put that to the test today to see if we can find any trends of what really makes a profitable dental practice as far as your financials go. So strap in, get ready, it's going to be fun. Okay guys, so to kind of explain this study a little bit as well, these are all people that we have had a very, very, very deep hand in assisting in getting their financials together. So it's very important that whenever you look at any type of these studies that there's some consistency involved. A lot of the times whenever an ADA study comes out, these are based off of surveys of people giving them information. These people giving the information will have classified things in different categories in different ways, and the studies will come out a little bit flawed. So they may have more of a population, more of a number of respondents than 25 practices like we're looking at here. However, all of these 25 practices their financials were created very, very similarly. They were all helped to be created from my company. So my employees, myself, we all did the same things for each of these practices. Our processes were always the same. We helped train the staff members in the practices that we were helping the same way, and we have the same systems set up in the same exact way. So there's consistency throughout all of these 25 practices. So number one, it's important that we have that as a starting block, that we actually look at the fact that they were all created in similar manners. That allows us to put more relevance to the data output. Now, I'm not going to lie, a population or a sample size of 25 practices is not enough to have absolute statistical accuracy to, whatever the high 98th percentile on a bell curve is when you're looking at a standard deviation. I'm not a big stat nerd. I do understand statistics in a pretty intro to statistics level, but whenever we're looking at this, we're really looking more for trends that could be pointing us in certain directions, rather than saying with absolute 100% definite accuracy that if you have 6.3% on your dental supplies, then you're going to make $1 billion this year. That's not what this is for. The purpose is to be able to let us see some of the indicators of success in different dental practices. Okay, so guys, the very first thing that I noticed when I was looking at all these numbers, what I did is I separate out revenue first, obviously, and I sort everybody by revenue. So how much revenue have they done for the year? So when I'm looking at my Excel spreadsheet, it goes from the most revenue practice down to the least revenue practice. And obviously I've got a lot of columns in the spreadsheet showing me these different numbers, and it can be a little overwhelming if you're just looking at those. So what I did is I then added a column at the beginning to be able to show me the averages amongst all of these practices, and set that up as a way of looking at those profit and losses in a combined stat. So I have a reference point on these different practices to say, okay, this is doing better than the mean versus this one doing worse than the mean. So it gives me some type of a basis to say, okay, there's room for improvement here or not room for improvement there. What I did next is I separated out all of the expenses that I felt could be discretionary. So the owner's pay, the owner's wages is something that I would consider to be discretionary. The interest expense paid on a loan, while it's absolutely required that you have to pay that loan and you have to pay interest expense on that, some practices don't have debt services. So I separated that out. I also separated out tax adjustments like depreciation and amortization, and I also separated out rent. So why would I separate out rent? The reason is because a lot of dental practice owners own their own real estate. Some people have these weird setups where they don't even pay rent. And so it just wasn't uniform amongst all of my practices. So I actually separated that out as well. So I actually separated those into their own category, which I called owner-specific expenses. So it's not quite seller's discretionary earnings or anything like that. It's just items that the owner has a lot of control over and are very specific to their circumstances. So I divvied out the things that were in separate practices that would make the study be not as conclusive. Okay, guys, so let's kind of get into the actual results that I saw. So in the group of the 13 practices that are going to do more than $1 million this year, again, we looked at the first 6 months of the year, and we've got right around $10 million in data. So we've got $10 million in revenue that we analyzed throughout all these 13 practices, which I guess that comes out to about $700,000 a practice average for the first 6 months. Duplicate that, and then our average practice would be pretty good size. So here are the things that we saw. Number one, the cost of doing the services, the cost of service is what I call this grouping of expenses. I call the assistant cost, the dental and clinical supplies, the lab fees, and your hygienist cost is your cost of doing services. I also include associate pay inside of that, and the mindset behind that financial grouping is that if somebody comes in the practice, this is what you're spending to give them that service. There is office and administrative costs that are a part of that. However, that is more general and administrative expenses. The financial theory that goes behind it is that whenever you have any type of service that you're giving someone, is that if no one were to come in to utilize those services, then you wouldn't have any of these expenses. So if you didn't have any patients, you wouldn't have any associates, any assistants, you wouldn't have to buy any supplies because you wouldn't ever use any. You wouldn't have to spend any money for labs because you wouldn't have any reason for it. You wouldn't have any hygienists because they wouldn't be doing any services. Now, yes, in that same hypothetical situation, you would also not have any, assistant or any clerical people, business team people, because nobody's coming in. But the expenses we talked about there, they seem to rise and fall along with revenue more closely than those other expenses do. So basically what we're saying there is that those expenses, that grouping of expenses, correlates. It goes up and down with revenue more than general administrative expenses do, which you'll notice I separate out the business team as a general and administrative expense. And the reason is because what I have seen, at least historically, is that the general and administrative cost don't typically increase along with revenue comparatively to those other expenses. So as far as the grouping, again, of the cost of services, which I define as the cost of services, is the associate staffing cost, the assistant cost, the dental and clinical supplies, hygiene staffing cost, and the lab expenses. That's the cost of services. So on average, on that $10 million in revenue that we studied, 41.2% of all the money received went to those expenses. So that's 41.2%. So every dollar that came in, 41.2 cents went to those expenses on average across all those 13 practices in the bigger company, in the bigger practices doing more than $1 million this year in revenue. Now, of that, to break that down a little bit more, 8.1% went to associates. So it's important to define out what the associates are getting, specifically because your associate pay is derived from your associate contracts. It's a separate thing. So those associates shouldn't be getting paid typically without providing dentistry, without creating revenue, creating production in some fashion. So we always like to look at those separately as well, because if you think about it, based off what we said before, the amount of dentistry being done goes up and down with these costs of services. Yes, associate costs would be included in that. However, you could really make an argument to say that you could have cost of services minus associates be an indicator of spending money well. Of the dollars that we generated in revenue, how are we spending that money to create that revenue? How are we servicing that revenue? How are we spending our money? And you could definitely say that the associates, because of the way that probably 85% of contracts are written out, those contracts are specifically designed around the creation of that revenue. So if you didn't have the doctor pay in there, what are you paying everybody else to make sure that this stuff is being created? So that's the reason you kind of separate that out. So the average without the associate pay in there is 33.1% in the bigger practices. So for every dollar that comes in, the bigger practices are spending 33.1 cents per dollar. So for the smaller practices, the practices between $500,000 and $1 million, whereas the total cost of services was 41.2%, typical mindset would be that the bigger practices would usually be a little bit more profitable. We actually found that the smaller practices had a total cost of services of 39.2%, which is almost exactly 2% smaller amount than the bigger practices, which is definitely not what the typical mindset is between these practices. So 39.2% including associates. If you take associates out, then we are actually at, 30.3% cost of sales without associates. So bigger practices on this study, for every dollar that came in, they were paying, for the bigger practices, 33.1 cents per dollar in these expenses, not including associates. The smaller practices are actually spending 30.3 cents per dollar. So the smaller practices were getting to keep 3 cents per dollar less than the bigger practices. For associates in the smaller practices, we actually saw that number was fairly comparable of the pay. It was 8.9% in the smaller practices and 8.1% in the bigger practices. So the bigger practices spend a little bit less on average, and the reason I derived from that is that they're generating more revenue, and so it's a lower chunk of the revenue for the associates to be paid on that. Okay, so looking at the smaller group, the practice is doing between $500,000 and $1 million a year in revenue. We've got somewhere around $5 million a year, $5 million in revenue that we're analyzing versus the $10 million in the prior group. This one has about 12 practices that are involved in it. And we've got, I guess it's closer to 4.6 million than 5. But anyway, they were spending 30.3 cents per dollar of the revenue that was deposited. They were spending down on the cost of services group, not including the associates. And there's a definite trend on the practices that did the best in this grouping. And there's a very common thread between those two of these practices that they actually, or three of the practices, which spent 22 cents per dollar, 26 cents per dollar, and 26 cents per dollar in total in those practices. And those three practices are all owned by the same person, and they have a centralized grouping where they actually can, instead of having 3 AR people, they've got 1 AR person, and they split a third of the cost between those three practices. So that's definitely 100% a way for practices to be more profitable, and that is proof in the pudding, specifically from this study. And so if we actually we could make an argument to omit those from this study if we wanted to, because they are so profitable comparatively. But I kept them in there. If we were to remove those, it would actually take our average from 30.3 cents per dollar up to about 32.5 cents per dollar. So almost, within a half of a cent per dollar similarity between the bigger practices, which I found that very interesting. So if we had removed those very, very profitable practices that are group practices, then it would be different. So again, there's never going to be 100% apples to apples in any of these studies, because every practice is different. Every practice has different demographics. They have different owners at the helm that do different specialties. They have different types of patients that come in. They have different types of employees. They have different types of goals. They have a million different things that go on in their practices. So there's no two dental practices that are exactly 100% the same. However, there are similarities, which is what we're looking at today. So the difference in the revenue ranges in this grouping is much tighter than the $1 million plus area that we discussed earlier. So in this grouping, we actually have we have 6 practices that will do between 800,000, really 850 and $1 million this year. We've got 3 that will do between 650 and 850, and then we've got another 3 that will do between right around 500 and 600,000. So those are kind of mini groups within this grouping. I definitely see that the practices that have gotten to the $850 to $1 million range, they actually have typically they have less dollars spent per dollar, less cents paid per dollar of the cost of services area. I'm looking at an average of about 30 to 31 cents per dollar in that grouping of 6 practices compared to the 30 cent average. And it really seems like it's one or the other. They don't hit the average. It's either they're at 26 or 27%, or they're at 35 or 37%, somewhere in that range. So they either do really well with that, or they go way above. There's not very many people that are just hitting the average. And the practices that are doing 650 to 850, they are doing right now a little bit more centralized grouping of being at the average of the 3 practices. And then the smaller practices actually are the most profitable ones in that retrospect. And the reason is because in that $500,000 to $600,000 range of these practices that I'm looking at now, most of these do not have a full-time hygienist. So their cost of services are just lower. They actually are doing 26, and 21% cost of services, not including associates, and actually one of them actually does have an associate in there. So that is for the smaller grouping. So again, it's not just, there's not just this cookie cutter approach to saying you need to have exactly 6% in dental supply cost. That doesn't exist. For these two, groupings of the $1 million plus and the $500,000 to $1 million area, the two numbers for the practices that did over $1 million, their dental supply cost averaged 7.1%. For the practices that did $500,000 to $1 million, they actually did 7.2%. So within 0.1% difference on the average. So if you ever hear someone saying that dental supplies can't get down to 7%, it absolutely can. That's actually the average amongst these 25 practices combined is 7.1%. However, different circumstances warrant being closer or farther away from that supply cost. So if you're real far off from there, then you got something to look at. Other things, lab expenses for the practices that did more than $1 million, it's 6.5%. For the practices that had less than $1 million but more than $500,000, it was 5.8%. So I thought that was kind of surprising that the practices under $1 million had less in labs. My conclusion to that is likely that the practices that do more than $1 million probably have some bigger cases on average, which means they have more labs typically, which means that they've got, compared to their revenue, they probably do a lot more implants, more braces, and things like that make it a higher percentage of expenses. It's still not, that far off. 5.8 versus 6.5, that's 0.7% different. But I thought that was pretty interesting to look at. Okay, so we talked about the total cost of services of every dollar of revenue deposited into our bank account. We're spending this much money again. So for not including associates, for the bigger practices, it's 33.1 cents per dollar. Smaller practices, 30.3% per dollar. The thing that we have to remember though is that is just an average. Averages in and of themselves aren't that. They're good to be able to show you kind of what is attainable, but it doesn't always show you the real picture. So when I'm looking at these 13 practices in the bigger study, as revenue increases, we actually see that it seems like that the practices that are just right at $1 million in revenue are actually doing a little bit worse in that amount. The average is actually driven up in certain ranges of these revenues. So just for, it's hard to explain this without you guys seeing this, but we've got practices, we've got, quite a few, we've got 4 practices that are going to do between 1 and 1.1. We've got 3 that are going to do between 1.2 and 1.3. We've got 4 that are going to be doing between 1.4 and 1.6. 3 that are going to be between 1.4 and 1.6. And then we've got 1 that's going to do $2 million. We've got 1 that's going to do 2.4, and we've got 1 that's going to do $3 million. So we've got a pretty wide range of different revenues within that study of 13 practices. So when I was looking at these numbers, I was like, why is this, why aren't these cost of services higher in this group than the other group? And to me, the main reason has to be that my sample size or my spread of revenue is too great in a study like this. So to make this a better study, if I had a choice, I would use specifically ranges of those that I just cut out. I would like to have 10 or 15 in each of those different areas, but for purposes of the study, we just don't have that data available because quite frankly, our accounting firm is just not that size. So use these averages again to be indicators of what's possible. So when I look at these different practices, the numbers are definitely centralized. So of the practices that are doing 1 to 1.1 million, they're ranging, between, let's see, 33 to 40% of cost of sales without the associates. So they're actually doing worse on average than the average. The practices that are in the 1.2 to 1.3 range are actually on the lower end of that spectrum. The practices that are in the 1.4 to 1.6 range there's two that are below average, and there's one that's above average by about 20%. And then finally, the biggest practices, the two bigger practices, are both well below the average. They're actually both below the smaller practices average as well. So what does that say to us? So to me, what that means is that there's a lot, in between that 1.6 and $2 million range. To me, it looks like there's a lot of chance. There's a big chance that your practice is going to be bloated in expenses. That is a difficult range, which I find is interesting. It seems like they spend, on average, more in dental supplies, spend more in labs, and I'm not quite sure if that's a revenue problem or if that is a spending problem. So I actually have done a revenue analysis as well that I may or may not share that information through the podcast, just because it is pretty high value and it's something that we do as additional for clients. I'll have to think about that one. But as revenue increases, I'm seeing some groupings of problems in the expenses that are coming out of different practices. So how can you use that information that I just shared? You can use that for planning purposes to know, hey, we might have a little bit of a rocky road between that 1.6 and $2 million range of spending money. So we have to be very aware that we can't let these supplies get out of control, or labs, or what we're paying for our hygiene team and things like that. So as far as total profitability for the practice, the numbers that we came up with, the practices that do over $1 million a year in revenue, we came up with the average profitability being right at 49.8%. So not including those owner-specific expenses we talked about earlier, of every dollar that came in, the practice had 49.8 cents that was profit. That includes paying the doctor, paying, again, that includes rent. If we were to add rent back on there based off of these studies, we'd be adding about 4%, which would mean that the profitability would go from 49.8 down to 45.8, which, if you've heard people talk about overhead, most people say that you should be aiming for about 55% overhead, which would be exactly what 45% profitability meant for the bigger practices. For the smaller practices, the smaller practices on average were actually a little bit more profitable. Their average was 53% with if you were to take out rent, it's also 4%. It'd be 49% profitability. So the smaller practices were 49% profitable. The bigger practices were 45%, 46% if you count rent. So I thought that was interesting. Again, the general consensus is that the bigger practices are more profitable. That 45 and that 50% that I just talked about, or 46 and 49, whatever it is, that is not including associates pay. So that's also the money that you'd be able to pay the associates with. So the reason you don't include the associates in that overhead calculation is that you want to know what the cost of service, you want to know what the total cost of running the practice is before paying doctors. Because you want to know, if you were to remove yourself completely from this practice and to be paying, how much money would you have to be able to pay your associates with? What is the amount of profitability you have to be able to pay those associates? So that's the reason we pull out the associate pay in this analysis. Other interesting things, the staffing cost, not including associates, For the bigger practices, it was actually 26.8%. For the smaller practices, was 24%. Again, I think that the reason about that is because the smaller practices are more likely for the dentist to be doing more of the work on the hygiene side. So some of these practices don't have a hygienist in it yet, or a full-time hygienist. The doctor may still be doing some of the hygiene because they're not just a practice that does $550,000 or $650,000 a year. I've seen a lot of dentists actually do all of their own hygiene. They don't like doing it, but they know that they can get away without hiring someone, so they do. So that's probably the reason the staffing cost is less. If you look at the difference between those two staffing costs, 24% is the staffing cost. For the smaller practices, 26.8%. That's about 3%, which is about the difference in the profitability total between those two groups that we talked about. So that actually could say that that's the reason that the averages came out to those ranges. So that is the total profitability of the practice. That is what you get to keep if you were to be running one of these practices. I find it very interesting that basically across all of these 25 practices, even though I split them up into two groups, the averages are pretty similar. They're not that far off from each other as far as what an average practice does. Now, I absolutely have practices that the profitability, while it was at 50% for the bigger practices, one super interesting point is that my two biggest practices, they're actually both right at 60% profitability. So as far as like the trends in revenue, it shows me that once you break past the 2 million mark, you actually have, as far as from these two practices is how they are run, they actually have a better shot at being way more profitable than a smaller practice does. Because there's a big difference between 60% profitability and having 50% profitability. And a lot of these other practices are at 40% profitability. I've got one here that's at 36, 50, 43.9, 55.8, 44.2. So it's a wide spectrum of profitability in these different practices. I hear so many people talk about averages, and they don't point out the fact that an average means that there's both a high and a low. If you want to be better than average, I'm giving you a point to shoot at. But again, remember that these numbers are a measure of how effectively we are spending our money to go out and create more revenue. Without system and processes in place, you're not going to be able to change these numbers. Now, for example, dental supplies. You've heard me harp about dental supplies many, many times about how you've got to negotiate with your vendors. You've got to make sure that you're getting the best price. You got to price shop. And it doesn't have to be specifically you, but someone on your staff has to be doing it. That is a way to be able to affect these numbers, is to be able to set up a process that, say, your assistant knows to every time we have a supply order over $200, then we go out and we price check once every 6 months on this specific item. That is a process that will affect these numbers. How well are we spending our money in these areas? Typically, the cost, the practices that have less profitability, that I was talking about earlier, have more in staffing cost as well. I'm definitely seeing a correlation to see that the practices that don't do as well from a profitability standpoint but are similar in revenue, it's typically the staffing cost that's the issue. Typically, it's not 100% correlation that I'm seeing here, but it's definitely a trend. So what does that mean? Again, I'm not going to really talk about it. I definitely uncovered some of this in my further study into this because I actually analyzed revenue as well for a lot of these practices. To me, it looks like that staffing cost is being influenced by revenue not being optimized, revenue not being done in similar fashions. I'm definitely seeing trends in the really profitable practices of how they're, how that revenue is coming in. In other words, things like, how many crowns per patient, how many visits per exam. So how many of every person who comes in the practice, how many get an exam, how many get a prophy, how many fluorides are we doing per hygiene patient, how many perio treatments are we doing per hygiene patients, how many x-rays are we doing per hygiene patient, what percentage of our revenue is coming from crowns, what percentage is coming from fillings, number of buildups per crown. All of these things, I'm seeing correlations as far as the revenue goes towards those profitability numbers. Again, keep the context of that the profitability of your practice may not be as high as the average. If you're in these ranges of revenue that we just talked about, then the number one place is typically, to me, what I'm seeing is staffing costs that get out of control. Dental supplies and labs, yes, absolutely. You can affect those and you can get those lower. If you don't know how to do that, send me an email, jonathan@dentistmetrics.com, and I'll happily share with you the information I've seen other people utilize to be able to lower those costs. And if you want to be a part of one of these studies in the future, if all you have to do is become an accounting client. If you do that, then you'll be a part of this. Every one of these clients are going to get time with me to look at their numbers versus what the averages were. We're going to dig into revenue. We're going to dig into all these things to be able to see what we can diagnose in their practices to see how they can improve their numbers. Again, metrics are always a result. They're never something that is going to influence further results. Numbers can't do anything on their own. Numbers are key performance indicators. Performance is the key word in the word key performance indicators. You have to perform something, you have to set up something in order to be able to influence those KPIs. So all of this analytical study that I've done is financial management related. So it's the managing of how we spend our money of deposits coming in. If we want to really, really diagnose how to make more money, you can always, save a buck or two or percentage here or there. The way that you really make the more profitable dollars is by doing the revenue analysis, by really looking at how is our revenue coming in and how can we better influence that to be higher. I did an interview with Dr. Mark Costas from the Dentalpreneur podcast, and he summarized it very well, that you can always beat an overhead problem with more revenue in a dental practice. That's just the way the economy works in this. But you have to have some systems and processes in place to make sure that you're not just generating revenue based off of a bloated financial statement. So hopefully this information has been informational. I'm a very visual explainer, so this has been kind of difficult to me to be able to just kind of rattle off a bunch of numbers. I hope I didn't lose a lot of people. I'll try and create a resource for a report surrounding the study. Right now, I'm not spending my time on actually creating that paper. However, if you want to get on the list for receiving that paper, whenever it does come out, it should be out in the next month and a half or 2 months. If you want to get the actual study that I do with all of my notes, with all of the analysis, it's going to have a lot of graphs, a lot of charts, a lot of data points to be able to show correlations between different numbers within practices that point towards profitability, including on the revenue side. If you want a copy of that report, just shoot a text to 33444, text the word practice to 33444 to get on the waiting list for that paper. I haven't created it yet. It's in the works. It's a lot of information to go over, and I'm diligently working on this to try and get this study out because it's really interesting stuff that we're uncovering. So if you find the stuff interesting, if you're a stat nerd, if you're someone who just likes to look at the numbers involved in dental practices, this is going to be a really, really helpful tool for you in the future. And maybe you don't even own a practice yet, but these are definitely going to be things that are going to be able to open up some of your eyes to why some of these numbers are important comparatively to other numbers. So again, the bonus for today is to get on the list to be notified when this paper is released. So text the word practice to 33444 to get on that waiting list to be able to know as soon as that thing comes out, as soon as that paper comes out in my analysis and study. It's going to be really interesting. I'm putting a lot of energy into it, which means it's definitely going to be good. So look forward to seeing you on that list. I hope that you've enjoyed today's podcast. If you have any questions, shoot me an email. I'm more than happy to answer them. Jonathan@dentistmetrics.com. And thanks for your time today. So that's it for today's episode, but that doesn't mean that the learning and implementation have to stop there. I've created a free report called The 15 Numbers That Will Make or Break Your Dental Practice. This report has been downloaded over 1,000 times by dental professionals. So if you want your free copy of this report that's going to outline what the most important numbers are in any dental practice, and it also includes how to look at your numbers, how to set goals, has a whole slew of really important information that is the culmination of all of my experience as a dental CPA, then just go to startyourdentalpractice.com/free gift. That is startyourdentalpractice.com/free gift. And so that's it for today, Ambitious Dentist. Again, I'm Jonathan Van Horn, CPA and ABV. I'll see you next week with another world-class practice owner or consultant that will help you start your very own dental practice. Thank you guys so much for being a part of the Start Your Dental Practice community. If you enjoyed today's episode, please do me a favor and go to startyourdentalpractice.com/iTunes to leave your honest feedback and review on iTunes. It's going to help me create a better experience, a better show, a better podcast for you, the ambitious dentist. Your feedback really does help, regardless if you like the show today or not. If you didn't like the show, let me know, because it's going to help me create a better show and podcast for you. Lastly, if you know of anybody that would benefit from today's episode and today's content, today's guest, please feel free to share with them on social media or through email.